Okay, so if you've looked at your portfolio recently, you've probably felt a bit of whiplash, maybe some relief. After weeks of that just slow, painful grind downwards, things are finally flashing green again. But here's the big question that what everyone's asking. Is this rally for real? Or is it just another fake out, driven by headlines?
That's exactly the tension, isn't it? And that's what we need to unpack in this deep dive. The sources we've looked at paint a really mixed picture. You've got these immediate kind of volatile political things happening, but also some deeper structural shifts with institutions. So our mission here is to get past those flashy headlines. We'll break down what actually triggered this bounce, look at how market sentiment might genuinely be shifting, and then try to synthesize these, frankly, conflicting long-term views from analysts and big reports.
Right. The goal for you listening is to understand the actual mechanisms behind the volatility right now. Why is Bitcoin testing $106,000 so important this week? And where's the serious money looking beyond just Bitcoin and Ethereum? So let's jump right in. What news actually sparked this latest move?
Well, first off, we have to be clear. This climb back towards 106K, it seems like it was almost purely triggered by macro and political stuff. It wasn't some, organic wave of market conviction building up.
So Washington News is driving the crypto bus again. Uncertainty goes down, risk assets pop up. What was the specific headline?
Yeah, pretty much. The first big driver was things looking better on the U.S. government shutdown front. President Trump confirmed a Senate deal aiming to fund the government through January 30th. Just easing that immediate political messiness, poly-market bettors are now giving it like an 85% chance of being resolved this week. That's usually seen as good for risk assets. Less chaos, more appetite for growth, right?
Okay, that makes sense. But I heard there was something else, something a bit juicier that really got retail excited. Stimulus talk.
Exactly. That was the second driver. Trump mentioned these $2,000 stimulus dividends supposedly funded by tariff revenue. Now, that immediately sparked speculation, potential flood of retail cash. Traders, they jumped on that, trying to front-run potential flows, especially into alts.
Okay, but here's where it gets tricky, right? This is where the fragility you mentioned comes in. That speculation hit a snag pretty quickly.
It did, almost immediately. Treasury Secretary Scott Bessent stepped in to clarify things. He basically said those payments might actually end up being tax cuts, not direct checks hitting bank accounts right away. And if that's the case, well, that immediate liquidity boost the market just priced in, it gets seriously dampened, maybe disappears entirely.
So, okay, the rally's built on political news. That news is already getting walked back a bit. What does that mean for this $106,000 level for Bitcoin right now?
It means everything. Honestly, analysts are pretty much unanimous on this. The rally is fragile. The market's still mixed. For this move to mean anything more, to not just be another fake out, Bitcoin has to break and firmly hold above 106K. That is the line. If it fails there, the consensus is clear. Expect a pretty sharp rollback once this political buzz fades.
Definitely sounds like thin ice then.
Yeah.
Okay, so if the immediate move is just news-driven, let's look deeper. Where is actual conviction maybe building? Our sources talk about a real mood shift. After that period of just, brutal chop and low confidence, maybe belief is back.
Yeah, there's some evidence for that sentiment shift. Look at ZEC, for example. It did a 10x in just 6 weeks. That kind of move, so sharp and sustained, it changes the psychology. It reminds traders that, yes, big pumps can still happen, so they stop feeling defeated and start hunting for that next opportunity, something maybe with real utility and strong fundamentals.
And when you look for a candidate for that kind of rotation, especially among the larger caps, one name keeps popping up in the analysis: Uniswap, UNI. Why UNI all of a sudden? What's the story there?
It seems to be this perfect storm, really. A combination of the technical chart setup looking interesting and fundamentals that are just unmatched. On the technical side, the chart's quietly improving. The weekly close is looking bullish. The RSI, that's the relative strength index, it's sort of flattened out near the bottom, suggesting maybe selling pressure is easing. And you're seeing spot volume pick up. If the overall market behaves, this looks a lot like a classic accumulation phase before a potential breakout.
Okay, technicals look promising, but the fundamentals you mentioned, they're kind of staggering, aren't they? Uniswap isn't just some idea. It's like the plumbing for decentralized trading. Let's just run those numbers again. What was it? $145 billion in monthly volume?
Roughly, yeah. And that generates something like $2.8 billion in fees on an annualized basis. Plus, it's got around $5 billion in total value locked. The TVL and the DAO Treasury holds over $2.5 billion.
That's a powerhouse.
Yeah.
Genuinely massive, real revenue generation. But then there's the big but, the paradox.
The huge paradox, exactly. Despite all that activity and revenue, the UNI token holders, they currently get zero value capture from it. The token is still just for governance. Voting rights, basically.
Right. That's the killer contradiction. Billions in fees flowing through the protocol, and the token itself doesn't directly benefit. It feels structurally broken, or at least undervalued. So why haven't they just flipped the fee switch?
Yeah.
Enabled that value capture already? Seems obvious.
Well, the historical answer was always one word. Risk, specifically legal risk. Turning on that fee switch, sending some of that massive revenue stream to token holders. It was seen as way too dangerous given the unclear U.S. securities laws. Just a non-starter for the longest time.
But something's changed. That legal roadblock isn't as solid as it used to be.
That seems to be the key shift. The big news is this emerging legal framework, the DUNA framework, the digital uniform commercial code, particularly out of Wyoming. This potentially provides a compliant path for the DA to finally enable that value accrual, without immediately getting sued by regulators. So if this narrative catches on, if the fee switch becomes a real possibility because the legal path is clearing up, redirecting even a fraction of that $2.8 billion, you and I could reprice extremely quickly. It's very specific, high-potential story institutions are definitely tracking.
Wow, okay. That's a fascinating setup technology, massive revenue, and now a potential regulatory unlock all coming together. Let's shift gears now, pull back from specific tokens and look at the bigger picture, the institutional landscape. Because it seems like demand is picking up steam there, but regulation is also accelerating right alongside it globally.
Yeah, absolutely. We've seen surprisingly strong institutional interest even when Bitcoin itself was shopping around. Take the Bitwise Solana ETF. It pulled in, $545 million in net inflows since it launched. That number really stands out because during that same time, Bitcoin and Ethereum funds were actually seeing significant outflows. It confirms institutions are actively looking for growth beyond just the top two coins, diversifying.
So institutions are buying, but regulators aren't sitting still, are they? What are the key moves happening globally? Europe, Asia?
Definitely not sitting still. In Europe, the Bank of England is getting quite specific. They're proposing pretty strict new rules for what they call systemic stablecoins, backed by the British pound. They want strong backing requirements and even temporary caps on how much individuals can hold. All about financial stability. It shows central banks are watching stablecoins very closely, worried they could become too big to fail quickly.
And regulation, prompted by bad news in Asia, too. There's a major hack.
Correct. That big $312 million hack in Japan seems to be pushing their regulators, the FSA, the Financial Services Agency. They're now expected to make crypto custody providers formally register. It's all about tightening security, making exchanges safer across the board.
Great. And back in the U.S., the ETF train keeps rolling, expanding beyond just BTC and ETH.
Oh, yeah. The U.S. ETF scene is definitely signaling more growth is coming for other assets. We're already seeing 5-spot XRP ETFs from major players showing up on the DTCC's active list. That's usually a very strong signal that approval is near, potentially a mid-November launch maybe under the SEC's newer rules. So that institutional on-ramp, it's being built out for a wider range of altcoins now.
Okay, so we've covered the immediate news, the sentiment change, the regulatory stuff. Now let's look ahead. And this is where things get really interesting because the expert outlooks we're seeing seem to clash quite a bit. Short-term optimism versus some serious long-term warnings.
Yeah, this contrast is really important to understand. Let's start with Benjamin Cowen. He's always very focused on market cycles, technicals. Right now, he actually sees a short-term bullish signal. Why? Because Bitcoin managed to get back above its 50-week moving average. That bounced from around 98Ks back up towards 106K. He sees that as technically positive action.
And it sounds like but his optimism is pretty short-term, right? He has a major warning flag further out.
A huge one, yeah. Cowen injects a serious dose of caution looking out towards 2026. He expects what he terms a healthy correction. Now, he does not think it'll be like the old 80% crashes, but still a painful, maybe 50% drop from whatever the next peak is. He really believes that 4-year cycle pattern, maybe softened a bit, is still fundamentally in play.
And his view on altcoins hasn't changed much either. Still bearish even with this bounce.
Very bearish on alts, generally speaking. He points out that Bitcoin dominance has been rising for 8 straight weeks. His take is that historically, even after these relief rallies, alts just tend to bleed back value into Bitcoin eventually. So for Cowen, the message seems pretty clear. Focus on Bitcoin. Be ready for turbulence in 2026.
Okay, that's one perspective. Cycle-focused, technically driven, cautious long-term. Now, let's flip to the other side. The institutional view, particularly from that Coinbase institutional Q4 report, which Coin Bureau summarized. That sounds a lot more bullish, at least near term.
It definitely leans more bullish in the shorter term, a pretty striking number. 67% of the professionals they surveyed see Bitcoin hitting $130,000 or even higher within the next 6 months. But there's nuance there too. Many of those same people also feel we might already be in the later stages of this bull cycle. So it's like optimistic, but nervous optimism.
What's making them nervous then? If they see a $130 a year K coming, what's the biggest risk holding them back from really piling in? Is it still regulation?
Surprisingly, no, not primarily regulation, according to this report. The main worry is still macro stuff. Stubborn inflation, maybe unemployment ticking up, unexpected policy changes from governments or central banks. Those big picture economic factors are what's keeping institutional money a bit cautious, even with those high price targets.
And maybe the single biggest narrative shift highlighted in these sources. Institutions aren't even looking at spot ETFs as a major catalyst anymore.
That's a massive takeaway, yeah. ETFs are now just seen as essential plumbing, infrastructure, a necessary on-ramp, but not the event itself that drives the market up. And demand is picking up through that infrastructure. Interestingly, ETH ETFs actually saw more inflows than Bitcoin ETFs in the third quarter. That strongly suggests the rotation into alts, especially ETH and also SOL, is genuinely starting at the institutional level.
Okay, so beyond ETH and SOL, did the institutional report point to any other specific areas, like emerged effectors where they see real growth potential?
It did. They highlighted 3 key areas gaining momentum. First, real-world assets RWAs, tokenizing things like bonds or real estate. Second was prediction markets. And third, something called digital asset treasuries, or DATs.
DATs. Can you quickly clarify what that means?
Sure. DATs basically refers to how large DAOs, like Uniswap with its huge treasury or other major projects, manage their significant pools of crypto assets. Institutions are getting interested in the potential around managing, governing, and deploying those big digital treasuries effectively. It shows the focus is shifting a bit, maybe away from just store of value and more towards the application layer, the utility, how these things actually operate and generate value.
Okay, wow. That was a lot to cover, a real whirlwind.
Yeah.
And I feel like the picture is much clearer now, moving beyond just the day-to-day price swings.
Yeah, hopefully cutting through some of the noise. So maybe let's try and boil this down to 3 key takeaways for you to think about.
Okay, first, remember that the short-term market moves right now seem heavily tied to political news, that government funding deal, the stimulus chatter. And keep your eye on that $106,000 level for Bitcoin. It's critical. The rally isn't confirmed unless we convincingly hold above it.
Second takeaway, that Uniswap fee switch story. It really stands out as a specific high-potential catalyst to watch. You've got massive real revenue meeting a potentially clearing legal path thanks to that DUNA framework. That combination could be powerful if it plays out.
And third, maybe most importantly, don't let the current green screens and optimism completely erase the long-term warnings. Even with institutions talking about 130K Bitcoin, respected analysts like Cowen are still bracing for a major correction, maybe 50%, potentially in 2026. It's a reminder that market cycles likely aren't dead, just maybe evolving.
Exactly. And that leads perfectly into a final thought for you to chew on, something building on that Coinbase report finding. If institutions now genuinely see ETFs as just basic infrastructure, not the big market-moving event anymore, then we really have to ask, what is the next big narrative, the next fundamental development that institutions are quietly getting positioned for, looking beyond this current rally? What are they really betting on next?
That's the multi-billion-dollar question, isn't it? It definitely keeps us digging into the sources. Thanks for joining us for this deep dive. We'll catch you on the next one.